Are you taking a reactive or proactive approach to your taxes? Do you wait until the year is over and hope for the best when tax time comes around? Is your business taking accurate tax deductions and receiving all the tax credits you deserve? Welcome to the Tax Answers Advisor with Marcelino Dodge. Today, we will answer these questions and many more. So sharpen your pencil and take some notes. Now, here is your host, Marcelino Dodge.
Hello, and welcome to the Tax Answers Advisor. So happy to have you here. This is Marcelino Dodge up on show number 39 and enjoying the wild ride. Another one today is we're going to extend our appreciation to a worldwide audience, not just the U.S., but those in China and Korea. You're certainly welcome in other parts of Europe that listen to this podcast. It's great to have you all as a part of our audience there. Also, if you're listening on this, you can have multiple platforms such as Google Podcasts, TuneIn, Amazon Music, and many other that you can listen to this on. So easy to find us if you just do a little look there. We discuss many topics on this, and as today we're discussing about buying and selling a business, but anything that comes up that we've discussed in the past or we discussed today, you're certainly welcome to email me at success@cashtracksfinancial.com. or give a call, which is 844-394-4287. You can schedule a free mutual exploration session to see if our services are what you need to help you to be doing better financially, either in your business or even personally. We provide those services, and you can schedule your appointment directly actually at cashtracksfinancial.com. On the homepage, you just scroll a little bit, click on schedule an appointment, and we can do that through video conference. Just so you can be comfortable and we can have a nice way to serve everyone across the country and be able to help you out, especially tax-wise. And as I mentioned about it earlier, we're talking about buying and selling a business today. Now, it seems like kind of odd with all the strange things going on, but people are still buying and selling businesses. But there are some cautions you got to have, especially tax-wise, which is why we're going to talk about today the tax challenges and headaches of buying and selling a business. And to do so, I invited Gennaro Cartaropoli today, a CPA with 12 years experience in public accounting in large and small firms. He's now the owner of Hortonist CPAs, offering tax and consulting services in the Fox Valley. He's from Wisconsin and has a master's in professional accountancy from the UW-Whitewater. Great. It's having Gennaro here with he's also worked as a lead tax specialist with the National Association of Tax Professionals, which also in our line of business is known as just NATP, which I'm also a member of myself. And that's how I met Gennaro and met a lot of fine tax professionals that I'm having on this program. And it's just great to be able to share and expand not only my own knowledge, but then help you as a listener do this. And also he's worked as a senior tax associate at Grant Thornton, where he actually began his public accounting career and oversaw and reviewed engagement in large companies with businesses in all 50 of the U.S. states. And that's great experience there. Wonderful experience in technical knowledge and tax law, and incorporates this into his own advisory services that he offers to people and individuals there. So I just want to extend a big, warm welcome to you today, Gennaro. It's fabulous having you on the program.
Thank you so much, Marcelino. It's a pleasure being here, and it's a pleasure being here in front of the audience, and to be able to extend the knowledge that I've learned throughout many of the listeners in right now, because there's one thing that's common with accounting and tax is that it's clear as mud. And it's always helpful to be able to, it's always enriching to be able to help explain it in simple terms for people to understand, to make informed and wise decisions in what they're doing. And in this case, buying and selling a business.
Mm-hmm. Yes, which is one of the reasons why I wanted to start doing this program is to just help individual people, because I've noticed a lot of podcasts seem directed more to professionals, and at least the ones I found anyway. But I really want to help a lot of individuals, because and I'm sure you do the same thing, just try to get things clearly explained to help people make the best tax decisions. So as we jump into it now, how do I know as a person on the street looking to buy a business or even sell it, how do I know what the value of my business is there?
That's a great question. And oftentimes that actually starts the lead of a lot of inquiries, whether you're buying or selling a business. Because if you're selling, you want to know what you can obtain from that. It's all your sweat equity that's poured into the business over years, that at the final sale you're looking to obtain or get back from. On the buying end, of course, you want to make sure you're not overpaying, and hopefully, sometimes some people try to look for a good deal on a business, but the value is ultimately based in a lot of sense on the cash flow that you're looking at from the business. So like the first thing, oftentimes I get a lot of inquiries that I hear about rules of thumbs. So the first thing I always want to talk about are the rules of thumb, because that's very practical, and that's what people often first times hear. So for example, someone might look to a bar or restaurant and say, oh, I've heard that it's 40% of sales plus inventory or something like that. Or in case of an accounting practice, I heard it's 1 times gross sales, something that you probably heard several times, Marcelino, right?
Yes.
And so the problem with that, with these rules of thumb or easy ways to calculate a value, is that they ignore a lot of important factors about a business. Similar to real estate, the location is a big factor. So where's the business located? That's a huge item, especially are you in a well-populated area? Are you out in an area where it's hard to market? That's a value that's difficult to measure, but it can ignore, depending on what the business is, the clientele, the value of that, the customer list, the contracts that the business may have acquired over the years, and the goodwill. And so that's the first thing that I always like to dispel these rules of thumb, because they do ignore a lot of those factors. Now, the second thing some people look to is say, let's take the profit times 3 or 4 times, an easy way to go about it. What's the profit of the business? Have you heard of that, Marcelino? Profit times 3 or 4 times?
That is one I've heard. And a lot of the items that you're mentioning there are all just, as you mentioned, rules of thumbs, things that you hear from just kind of general business people around. Well, it's X amount, or you say 3 times or 1 times the gross sales for the tax area or accounting. So a lot of these, but as you mentioned, I understand it takes a lot more than just these items. There's a lot more to it than just these and just what the sales are in those kind of areas. Definitely.
Absolutely. So now that's after discussing that. Now we get into really the nuts and bolts of what if you were to appraise a business or hire a professional to do a business valuation. There's several methods, and I'll try not, and I can go, this can be an all day course in of itself, but to take the nuts and bolts of it and to make it into a simplified version, there's 3 different methods or 3 different elements that we look at as, when we appraise or value businesses as CPAs. We look at, of course, the profits, a very important piece, because you're buying a business because you want to make a profit. Now, does that mean, though, like in that other sense that we're talking about 3 or 4 times profit? So if the business has ran out of loss over years, does that mean it's worthless? The answer to that is typically still no, because you take 3-4 times negative and you say, well, you got to pay me to take over the business. And sometimes that is the case, but you're ignoring other aspects that we look at when we appraise a business, such as the assets involved, the real estate, the property, the equipment, and what's been put into the business. And just like real estate, if you remodel your kitchen, you're not going to get that back dollar for dollar when you sell. But it is an important factor when you're buying a business or selling it for that matter. We all like to think that when we're on the selling side too, that what we have is worth more than what it actually might be. Very common of us. We're kind of attached to it, especially if it's a business you grew up from start. That's your baby. The second, and so there's the income, the assets, and the last part is the market approach. And what that means is we compare to other businesses that have been reported, as far as sales of similar size, compared to their gross sales, their ratios, such as ratios we can talk all day, such as your assets compared to liabilities is a big one, and say, what did that sell for? Again, I like to compare it to real estate, not that it's the pure thing to compare to, but a number might say that this is what it is based off profit. But if everyone else wants to pay a premium for this type of business, because maybe there's a safety in that, because it's a very low risk type of business that people tend to pay more for that type of business, that impacts the value. Just like right now, real estate's through the roof, no pun intended.
Yes.
That normally you might say, well, it's not worth 200,000. Well, right now it is, because everyone's buying it. So we blend those three approaches to appraise the business and come up with the value. That's the proper way. And that's what I would suggest, especially when you're looking at a large purchase. Right now, we're looking at one that potentially in the millions of dollar range. So they certainly want to make sure that they're not that it's overpaying for this business.
Yes. Overpaying is one thing. And then, of course, if you're on the other side, you're selling, you don't want to sell it for too little as well.
Absolutely. Like I said earlier, it's your blood, sweat, and equity you poured over the years. And sometimes for many people, the sale of your business is your retirement effectively. And, so you want to make sure you get what it's worth, it's worth for, unlike real estate where there's an open market for everyone to easily compare prices. Businesses is a little bit more difficult. And, sometimes I like to focus and advise through the whole process is you really got to focus on the relationship between the buyer and seller, especially if a seller is staying on board for a couple of years, because in a way, sometimes that the success of both can depend on the operations, and transparency is of utmost importance during this process.
Okay. Yes. And part of that value too is making sure that your business is basically doing good anyway. Don't wait till it's going down or whatever, which is maybe you work with some on this. But if you're looking at it as retirement, are you actually planning the sale? Are you looking like 2 or 3 years, maybe 5, 10 years down the road? Okay, I want to sell this business. I need to make sure it's at a certain level to be able to sell it, so that it'll be it, so I can get the value there. Not just wait. A year from now, I'm going to sell it. But wait a minute, but yet it's not doing as good as it could be or should be for you to be able to get that maximum value out of it.
I love that you bring that up, Marcelino, because that's such a practical thought, because some people will wake up, not everyone wakes up one day and you wake up in the morning, take a sip of coffee and say, I'm going to sell my business. It's usually over time you start thinking about that. And once you know that you're going to do that, you really want to start the process now of working on key metrics of your business to get the maximum value. Again, I like to compare to real estate because it's such a common thing that we can all relate to. But would you be willing to pay more for a house that's move-in ready, freshly painted, lawns cut, just freshly renovated? Absolutely, be more willing to pay more for that than something that that's a handyman special or needs some TLC. So you're obviously going to pay less for that because you need to do some work to get it to a good operation. So especially with businesses, sometimes sellers are burnt out and when they're selling, and at that point, if you want to get maximum value, sometimes you have to dig deep a little and improve some of the metrics of your business, such as profitability, or your cash position in order to sell and get a top dollar for it.
Yeah. Now, when you go into selling or even buying there, an important thing, and I had to deal with this a few years ago in consulting with an individual who was buying a business, but we need to look at, or at least closely examine, am I going to buy the stock of the business or I'm going to buy the asset of the business, and vice versa if I'm selling it as well. There, what do you find in these differences between the stock purchase or an asset sale, or what do you encounter more when this?
Great question, and something it's such an important factor and sometimes overlooked, because I will sometimes ask that as the starting point of a new client: are you buying the stock or the assets? And they'll look at me for a minute and pause and say, I told you I'm buying the business. But the way you're doing it is important, because there's two main ways you can do that. Like you mentioned, you can purchase the stock, or if it's an LLC, the units, or you can purchase the underlying assets for that matter. And the importance from both a tax and legal perspective cannot be understated in this approach. High level, sellers typically would prefer a stock sale, whereas buyers would typically prefer an asset sale. Maybe you've encountered that as well, Marcelino.
I've encountered that some too, although in the cases I've worked with, it's actually been more asset sales that we've done, not stock sales. So
I would agree. And that oftentimes you see more asset sales, and there's very good reasons for that. Differences, start with a couple basic legal ones. When you buy a stock sale, you're buying along with that all the liabilities that go along with the company, as well as hidden ones you may not be aware of. If there's, for example, if there's a lawsuit that's brewing that is unknown to anyone, you taking over as a buyer, as a stock sale, you are now taking over that potential lawsuit later down the road. That is now your problem, as well as potential tax problems along with the business. So, which is another item too that's a great topic that we'll be touching on later too. And cannot be understated. Whereas an asset sale, you are buying just the assets and typically forming a new entity. Therefore, the liabilities of the seller remain that of the seller, generally speaking. There are some exceptions. For example, in Wisconsin, if there's unpaid sales tax, doesn't matter whether it's a stock sale or an asset sale, the unpaid sales tax can attach to the new owner regardless and pierce that. It's by Wisconsin statute. So not all states have that provision. So you always want to make sure to check your state statutes too in regards if there's unpaid taxes, how that impacts you. So that's the legal ramifications. And then the tax ramifications get a lot more intricate, but basically it's more tax favorable from a seller to sell the stock for capital gains purposes. For the buyer, as an asset sale, they can write off a lot of the equipment faster, whereas you cannot write off the cost of stock.
Yes, exactly. And so this stock or asset challenge only comes in if you're actually dealing with like with an LLC or corporation kind of entity is where it comes in. Although I've seen in my area where it's actually been sole proprietorships that have been sold that where it's based essentially you are just buying some assets and some blue sky and so on with it there. So how about in that case with like the sole proprietors that sell that never incorporated, that still have $1 million in sales or whatever, but never became a corporation? Have you worked with something like that?
Once. And with the sole proprietor from that perspective is because there's no entity, you're not buying the person, of course. So there's nothing to buy in regards to an entity, in which case you're structuring it as an asset sale to buy the assets from that individual. Typically assign a value to equipment, if there's inventory, and oftentimes the remaining part that you're really paying for is like customer lists, a client list, goodwill, which is that intangible, that it's still worth something even though you can't really assign a specific value to a specific asset. And that ends up, and I usually recommend that if you're buying from a sole proprietor, you generally still want to set up an LLC or or a corporation to take those assets on and try to shield yourself from the sole proprietor's prior liabilities.
Oh yeah, definitely. They're vitally important. So then, and you touched on it a little bit there. Now we're buying it, whether you're buying it from a sole proprietor, buying it from an LLC or a corporation or whatever, you still got to allocate purchase price. Because you can have like $1 million or $2 million sale, but how much goes where, or how much applies to what each there. So how do we then turn around and make that allocation of the purchase price so that there are things like depreciation and amortization, those kind of areas will be accounted for properly?
That's a great question as well. And this part I actually enjoy being involved in. This is a great area too, that even if you're not involving so steps 1 and 2, we talked about, the value in the stock purchase and, versus asset sale. Sometimes between the client and the attorney, they've already gotten those two parts done. But I highly recommend if you haven't brought in your accountant or tax professional, CPA, EA at this point, that you definitely do so at this point at the asset allocation, because the IRS actually allows a little bit of flexibility between the two parties to determine how they want to allocate that price, because typically what's good for the buyer is not good for the seller and vice versa. So, so the buyer, if you're buying a business, you can first recommend starting off, if there's real estate, to get an appraisal on the real estate, because then you have a good underlying solid number on a tangible asset that's readily, effectively marketable if you were to sell. So that's your first step there. And then from there, you start looking at the rest and determining how you can allocate, the purchase price. And generally, from the buyer perspective, you want to see if you can negotiate allocating more to things like inventory and equipment and vehicles, because you can write those off almost very quickly or almost immediately through various methods, such as bonus depreciation, Section 179, et cetera. And whereas if you're allocating to intangibles as the seller side, you want to try to negotiate if you can get more allocable to goodwill or client customer lists, because those are capital gains from a tax perspective. But on the buyer side, you have to wait over 15 years to write that off. So the allocation can be somewhat arbitrary between the two parties, but once they come to an agreement, you're usually bound to that for both legal and tax purposes. So before the ink hits the paper, you may end up going back and forth a little bit and talking to your accountants to determine what your tax exposure is or tax ramifications is by certain allocations.
Okay. Yes. And certainly this is another area where maybe you've encountered it, but I occasionally do see it, where ones will start talking about these things, but forget to talk about their accountant or tax person about it, because they just don't, for whatever reason. They get all the other parties, but they don't talk to their tax person about it. And then they come back to me later on saying, look what I did. I'm like, kind of give them a blank stare and say, why'd you do this? And then explain the tax consequences to them afterwards, because they didn't consult first. So
I call those my cowboys. They shoot first and ask later. So, and I have literally seen an asset sale or a business purchase literally written on notebook paper, something like this with a bunch of scribblies on it, just handwritten, signed here on a one-page document. And the question was, is that binding? And the answer is, it can be, yes. It does. There's no specific, you don't have to have a 20-page document for this to be binding. However, if there is a disagreement, you're going to have a he said, she said problem later. But yes, if by not bringing in your professionals, it could be costing you thousands of dollars in tax later by either, poor tax consequences, paying more tax upon the sale, or being unable to write off certain expenses upon the purchase of the business. So, so it's kind of, I kind of classify it as I think they call it the penny wise, dollar stupid approach, where what you save a few pennies up front by not bringing in some professionals may cost you thousands later.
Yes. And I'm sure you've had that experience in a number of areas, just as I've had it. People come to you after the fact, after doing some things. So, okay, now, since we were talking about wanting to reduce tax and on selling a business there, so you're the seller, you're wanting to reduce your tax. What's going to be the best way we can do it?
So on the seller's perspective, this is an excellent point, because the seller, again, you've worked hard to build up your business, and now you're looking to sell. And the last thing you want is Uncle Sam coming in and taking 30 to 40% of your hard-earned money, upon the sale. So at this point, there's things that can be done, and some of them can be very simple. So one thing that I would like to ask is there real estate involved? Because if there's real estate involved in the business, you can potentially structure a part of the purchase price to be what's for the real estate portion to be considered a like-kind exchange. Meaning if you want to go from owning a business to some passive rentals that you've identified that, I want some passive income in retirement, that you can potentially roll that portion over tax-free. Another option that you can do is something called a seller financing, which can be helpful tax perspective, but on the same token, on the other side of the coin, you're are now the bank for the buyer. So I usually recommend a significant down payment so there's good skin in the game. But with the seller financing approach, for a lot of the gain, you can spread it out over how you're making payments, because our tax system is a graduated tax rate system. So if you're taking all the gain in 1 year, it's going to push you through the tax brackets to be in a higher bracket than you've probably ever seen before. So, and that's where you truly feel a lot of the pain. But by spreading it out over years, you can reduce the tax overall that you pay. And then there's also more advanced techniques that can be done, such as like some people might look to certain types of trusts, but let's say that kind of gets really involved and can be expensive to set up. And I would say certainly talk to your attorneys and tax professionals before going down that route. But those are kind of two common ways to reduce the tax upon the sale. Another option too is, sometimes, because you might be dealing with a lot of capital gains, some people might have a non-qualified stock portfolio, meaning it's an after-tax account that what we call is tax loss harvesting, where if you have a bunch of loser stocks, normally you're limited to $3,000 a year for when you take a loss on stocks. But when you have capital gains, doesn't have to be from the sale of stock. It can be from the sale of business, sale of real estate, that you can trigger those losses out of your portfolio to offset the gains from the sale of the business to the extent it's allocable to capital gains. Keep in mind that from the seller's perspective, that if you are selling assets, anything allocable to equipment and inventory, you're typically going to have to pay tax in the year of sale, regardless if you see the money, because it's just how the tax world works. The IRS requires that to be paid up front. So if you are dealing with a substantial amount of what they call ordinary income items, you want to get a sizable down payment to cover the tax bill on that.
Okay. So basically what we're talking is that you mentioned about in the tax world, it's known as an installment agreement, installment contract that we go ahead and file. So the tax payer that's selling would have the installment agreement set up and get the payments and do the reporting, which is why we're here to make sure that gets done correctly. He has some assets in the business that don't fall under the installment contract, and he didn't even get the money. I mean, he can have like $1 million sale, $200,000 of that are other assets that he didn't actually get the money for, but he would still have to pay tax on that $200,000, even though he didn't get the money. Is that what we're kind of saying here?
That very well can happen, yes. So like I had a situation where there was in this case it was smaller dollar amounts, but $50,000 was allocable to equipment, of a, so that way the buyer can write it off. In this case, the buyer was, I should say the seller was fully aware of the ramifications, and we structured it well to reduce tax, and they had some loss carry forwards to offset it with careful tax planning. But for the unwary, that $50,000, that equipment you wrote off because tax law allows you to write off equipment almost immediately. The tax man cometh at the time of sale to say it's time to pay tax on that $50,000 you allocated to equipment, even though you didn't get the money yet, because the tax law specifically states that the proceeds allocable to equipment is not eligible for the installment reporting method.
Yeah. So then a few years down the road, buyer's good making payments and everything. You got a few years down the road in such a circumstance there, and the buyer decides, well, I can get a better interest rate at the bank than what you're giving me. So the bank, I'm going to pay off the whole lump sum here. Now that lump sum happens to include the funds that you've already paid taxes on for some of that equipment and stuff that you already paid tax on. So he's not going to have to pay taxes again, getting that whole money, is he?
Correct. Right. So upon so the proceeds allocable to that $50,000 in the example I was talking about, let's say that is exactly what happened. that $50,000 you've already paid tax on. So that establishes what's called basis in your note. So basis is a technical term we use in tax all the time to essentially, to say that you've already paid tax on that element, so you have after-tax dollars in that asset, in this case, a note, so you don't pay tax again. The rest that you haven't paid tax on will come due at that time. And a little thing I would recommend too is that when you're setting up your seller financing, carefully think if you want that option, if you want to give that option to the buyer to be able to refinance like that. I had a situation that actually came up just recently with the low interest rates because she sold her business 5 years ago. And in the contract, it only allows at the option of the seller to allow a refinance. So the buyer was barred from reducing the interest rate or refinancing. So you want to be careful of how you want to structure that, if you want to allow an option to refinance or if you want to give a period. Maybe it's for example, common thing I've seen is like a 15-year amortization schedule or 15-year payment plan, but at year 2 or checkpoints like year 2 and year 4 or year 5, at the option of buyer or seller or both, if agreeable, they can say, let's cash in and be done with this. So you can structure the note, and that's where I say you want to bring in your attorney on to make sure that the note that you're structuring that it gives you the result that you're desiring.
Yes. Oh yeah, that is so important there. So especially in that year when, say, if that refinance does occur, that it gets calculated properly, or at least because they've been making these payments, principals down, but you got to come back. You say you got the basis there in that loan now. So, but you're not going to take that full like 200,000 off out of $1 million sale. You're going to have to prorate it according to what it is compared, that amount is compared to the rest of the items that are a part of that. Is that a correct assumption?
Correct. Yes. So, so essentially if you have the multi-unit, like they call it multi-assets, different classes that you have an installment sale on or a payment plan on, you're going to allocate that, in kind of what we do internally is we pull out our spreadsheets that we're known for as accountants, right? We have we love our spreadsheets, and we allocate the payments according to each of these types of assets. So that way part of it's, you're not paying tax on, but the other parts you are, which also brings up to one point we haven't touched on. You want to make sure you have an adequate interest rate in your payment plan. The IRS requires that you at least use the midterm AFR rate for your payment plans, which right now isn't a whole lot. I think it's around 1%. It's like 1.5%. It's really low, but you're required to have some sort of interest rate. It doesn't have to be as much as a bank. I personally recommend, if you're the seller, to make it adequate to the bank. Maybe, and if you're wanting, and depending on what you're desiring, sometimes I'll recommend make it what a bank would do plus 1 or 2% if you want to get the cash sooner, because, maybe you don't want to carry the note. Because remember, if you're the seller, you want to be able to walk away from this and have your money. That's first and foremost. I'm not going to say, do this for tax purposes at the risk of losing hundreds of thousands of dollars on your sale. So, so make sure that that taxes are important, but you also want to make sure that ultimately you're getting your money according to your plan.
Okay. Yes. And of course you got to have the plan, which is why you should talk to your accountant, your CPA, your enrolled agent, all of them before you go to sell, or at least start building your plan. So you have a plan when it does come that time. And of course, included in that plan is that if you as the seller have unpaid taxes, what happens with that?
That's a great, and that happens more often than you think. So, and then from a buyer's perspective, you want to ask, you want to do your due diligence and seeing if there are unpaid taxes for the business. You need to know about it. This is something that should be transparent. So it's a red flag if people are withholding information. The buyer and seller need to be transparent in the financial situation, including taxes. So as the seller, if there's unpaid taxes, it depends on the type of tax, because there's, as we know in the USA, there's a whole slew of different taxes. We got income tax, payroll tax, sales tax, and county tax, property tax, and then death tax even in some situations. Rare nowadays because the exemption's so high for death tax, but nonetheless, the first step is what kind of tax it is, because if there's unpaid taxes, I first like to look to first the ones that have most what you call nexus, or the most immediate taxes to the business, such as payroll taxes and sales tax and unemployment tax. And I tend to find this that that the states are usually very aggressive in pursuing sales tax and unemployment tax. And you probably experienced the same in Marcelino. So like in Wisconsin,
Yes.
I always joke that the IRS chases you for 10 years. Wisconsin state, the Wisconsin Department of Revenue will chase you for your life until you're dead. And then unemployment will exhume your body and take what's left. So
Yeah,
do you experience the same that in Colorado?
That's pretty much the same in Colorado. State tax department or Colorado Department of Revenue will do. They're pretty aggressive on sales taxes.
So upon the sale, what'll happen is that if you have unpaid taxes, typically at that point, if it's been going on for a while, you're going to have a warrant or lien against your property. So the tax man is going to take that money first. Now, if that somehow slips through the cracks, you can have issues where they can chase you after as well. Or if you're the buyer, sometimes maybe you're taking that on as part of the purchase price and paying that off. So that's part of the proceeds. So let's say if you're a seller, and I've had a situation where the sale, where the sale of the business, it was so encumbered between debt and taxes that essentially what happened is the buyer came along and said, I'm going to buy your business for $1. And that was the sale price, because I'm going to take over your debt, your line of credit at the bank. I'm going to pay off your taxes. And literally gave them a $1 bill at closing. Said, here you are. My client has that in the, he told me he has that in his toolbox to remember. But essentially what happens, that's part of the sales price, because they're taking over that debt. So if somehow you try to work around, like a lot of people say, well, how can I work around the tax man gets nothing? Well, there are, sometimes that some people might go down some aggressive maneuvers, but keep in mind that oftentimes there are statutes where it gives flexibility, where the government can try to attach it to the buyer or seller, depending on the type of tax. And keep in mind too, certain taxes are not dischargeable in bankruptcy, especially what's called trust fund taxes, like payroll taxes and usually sales tax. They will not go away in bankruptcy.
Because you had the money at some point.
Correct. That sales tax and the payroll taxes, effectively the government views it as that's not your money. The fact that you collected it doesn't matter. You held it in trust for the government. So and then the fact that you went and spent it doesn't absolve you from that. Effectively with payroll taxes, you're effectively indirectly considered stealing from the employees, because you withheld their taxes and were supposed to pay the government. So that's why they're so ferocious on those type of taxes and why it's not dischargeable.
Yes, and we've all encountered those ones who didn't wisely pay those things. So we have to keep after them. At least any of my clients I work with, that's not a problem with. We don't allow that to happen. So it only happens on new people coming into my office. We have to fix.
I completely agree. It's the same here. Usually that's where, we're helping on the back end, because they've come with this problem with taxes, and maybe the person they're working with didn't offer that kind of resolution service or staying on top of that, or maybe they weren't working with anyone. And all of a sudden, because the government, how the speed of the government is, right? How fast they are to respond, months can go by before something actually happens. And at that point, you've already racked up quite a bit of debt.
Yes. So let's move on to, we talked about it a little bit there with installment agreements as a way to finance their or buyer or seller financing. So what do we have in financing options if you are looking to purchase the business?
All right. So financing options range, obviously there's good old fashioned cash where you can just buy it for cash, but oftentimes many of us don't have, $1 million walking around or $100,000 in cash walking around in our pocket. So, so oftentimes when buying a business, we're oftentimes borrowing that money or financing it in some shape or form. So the first step is if we're looking at seller financing, we already talked about that, and then which is the seller is essentially the bank at that point. Oftentimes the buyer puts down a down payment to the seller, and there's a contract between the two where there's interest and payment schedule. So other options would be the next one up that most think about is a bank. You go to a bank to get a loan. And depending on the type of business, some businesses are harder to finance than others. So for example, bar and restaurants, typically banks shy away from because because a lot of bar restaurants fail within 3 years, after opening. I don't know if you've noticed that too, Marcelino.
Well, most of the ones I've worked with have stuck around for at least 3 years. So at least the ones I've worked with, I haven't seen that happen too much, but I definitely agree that does happen. Wait a minute. There is one to come to think about. Yeah, it can happen. It does happen. You're right. Yep. I just had an idea. I just had the thought come to my mind of ones I've seen in just in my area, but come and go within the 3 years. Yeah.
I have one that right here and where I live in Appleton, there's a location in downtown that's probably swapped out restaurant, like 3 or 4 restaurants in 5 years because they've failed so many times in that location. Something about bad luck there. But in any case, because of various reasons, oftentimes banks will shy away from that, or you have to find the right bank. So the first step I would say is that depending, especially if you're buying a small business or you want to cater the financing or the bank you're choosing to the size of the business you're buying. So if you're dealing with a small business you're taking over, you probably want to be looking with a local or small bank or mid-sized bank. Oftentimes larger banks, we all think that's all regulated, that they're all the same. That's not so much the case. It's still alive today where you still need a good business plan and how you're going to make the business profitable, because you got to sell it to the bank as to why they should give you the loan. And oftentimes they're probably going to either go one of 2 routes. They're going to either do the conventional financing, which is the bank taking on the risk, or they're going to go with SBA, oftentimes Section 7A financing, which is the SBA is involved, which provides some surety to the bank in case of default. But the SBA oftentimes is, has a lot of red tape that you have to go through in order to get those loans. So that's the next financing. And oftentimes it then depends if there's real estate involved. If there's real estate involved, you can potentially get a longer term on the note, such as 20 years. If there's no real estate involved, sometimes it can be harder to get a bank financing because it's hard, the bank doesn't want to repossess, in the case of a bar, a bunch of bar equipment and stools. Real estate's more sellable. So in cases without real estate involved, sometimes you're going to be limited to 5 to 10 years of financing terms. So again, you will need a sizable down payment. And then you can also want something too here that you can consider that essentially I'm working on one right now where it is a kind of a hybrid where it's seller financing for the first few years and over half the business is purchased, in seller financing and with a bank note. And then in about 3 years, it'll convert to a full SBA note because the rules are a little bit more lax. Once you've been an owner in the business for a couple of years and you've shown good results, the SBA loosens up a little guidelines as far as what you can borrow. So sometimes a hybrid, if the buyer and seller can work together, a hybrid can help that transition as well. And then lastly too is something that I've seen, and I'm going to pose you can also borrow from family. That's also an option too, which I've seen. You can get a capital structure where if you have like 5 different people who want to invest and be silent partners, you can have that too. So those take a little bit more knowing people. Sometimes people have gone to crowdfunding, which is rare, but like GoFundMe, but that's usually for new ideas rather than buying an existing business. And then the one thing I want to point out, maybe you've come across it a few times yourself, is what's called a rollover. In technical terms, we call it a rollover as business startups or ROBs. Essentially, it's a very complex way of doing it because, oftentimes we have a lot of significant retirement money, such as we built up 401k or IRAs over the years.
Yeah.
And it's a way that you can actually take that retirement money and start up your business without taking a distribution and paying tax on that. However, that comes with a lot of caution, in my opinion, because there's a lot of regulation around that, because you're usually setting up a 401k for that owns your company. And at that point, if you run afoul of the rules, the IRS can essentially liquidate your company and have you pay about, upwards towards half the value as a penalty for failure to comply with certain rules. So if you come across that, because there are certain companies that offer that, just to be cautious that you can have a situation where you want to follow the rules to the T, as they say.
Well, I usually don't recommend using your retirement funds to start a business or invest into a business, because that's pretty high risk for a person with their retirement funds to do. And I personally don't recommend it. I tried to actually talk a client out of it a few years ago, and sadly, they actually ended up losing about all their retirement because of what happened with that business, because that business just didn't work out. And but they had a tax bill. I don't know whatever happened with the whole thing, because I just dealt with a part of it, but it's still a caution, at least from my standpoint. If you're considering using retirement funds to buy a business, consider other options, or maybe just don't buy the business.
I agree. If you're at risk of losing half your retirement to buy the business, maybe it's something you want to take a pass on. You want to really think hard on, because you're putting your whole nest egg and what you've saved for when you do retire all into one basket. It's probably one of the riskiest moves you can do, and maybe you'd agree with that.
Well, that's I would call that the highest risk investment a person could make, because even in the investment industry, it's what they call small cap stocks are a higher risk than your large cap stocks. But this is even more risky than that small cap stock is. So definitely, at least from my standpoint, don't do it. It just wouldn't be a wise move. Now, one other area that I hadn't thought about, but I'm glad you mentioned it in our discussions, about asking for the seller's tax returns, or in this case, you say, or maybe even the buyer there. Is that something that we could, as a buyer or seller, be looking into?
That's a great question. And yeah, oftentimes I do. We'll recommend that as part of our due diligence program, as far as making sure, because here's the thing. Let's say you're buying a business and you're asking for the financials. The true test to know, like, are those legitimate, was that the same numbers reported to the government? And I'm not asking for their personal information. Redact your social security numbers, redact your address, but I want to see the name of the company matching with the financials, to make sure what you're getting is true, because it could also give insight if taxes are remaining unpaid. So you have both the income tax and the payroll taxes involved. And sometimes in small businesses, like very small, where they don't keep good financial records, the tax return might be the only thing that you can go off of. I've had situations where, and you probably have too, where buyer and seller agreed on a price without looking at any numbers whatsoever. So, yep, that's a good number. And there we go, off the business. But in that case, yeah, you can. And then especially if you're a seller and you're financing the purchase price from the buyer, you can ask for that, because you need to know, just like a bank would ask for your tax returns for financing. Yes. You want to know, can they end up paying you? What's their income sources? And it won't give you the full picture, but it will give you what was reported to the government. Now, of course, what I highly recommend in all cases is that what's called a non-disclosure agreement, or NDA, is signed between the parties, agreeing that none of this information can be shared with any parties, because, obviously this is very sensitive information. And if the deal doesn't go through, you agree to go your separate ways and never talk about it with anyone ever again.
Yes, definitely there on the tax returns. And certainly if you're concerned about the personal information, of course, some of the especially if you're talking corporate tax returns or partnership tax returns. There's only a few pages of those that would really be necessary for a buyer or seller really to have access to. I mean, like in the case of an S Corp or a partnership LLC, they don't need to see the K1s, how that was distributed.
Correct. Right. You don't need to see the K1s of all the owners and all their personal information. Just that the business tax return will have the key elements. Usually the first 5 pages are the first, or 6, depending on the type of entity, are the most important that you're looking at. Now, I usually recommend seeing the other schedules too, like depreciation schedules and whatnot, to see the assets involved. But you don't need to divulge all the personal info. Even if it's a sole proprietorship, where there's not a business corporate structure, there's only a few pages out of your personal tax return that contains the business info. And that's really what I'm looking for. I don't need to see what you're taking out of your retirement, or, what, how many kids you have. That's not my prerogative. But if I am financing you, if I am financing the buyer though, I do want to know what kind of income sources you do have, in order to make sure that you can end up paying me. So like if you have other like rental income, for example, I know you might have collateral or something that I can end up getting paid, because there is a saying that applies across all the board: you can't squeeze blood out of a turnip. And if the person, even if you win a judgment against someone, if they have no assets, no collateral, all you have is a piece of paper.
And certainly we want to be careful about that, which is why it's part of due diligence. Of course, as tax professionals, the due diligence we just do on people walking in the door is just very high, very tremendous. And we recommend that you, as a buyer or seller, you take the same precautions when you're looking into a business. And looking at the tax return is obviously a way to do that they can do that, so that they know, okay, is this something I should move forward with? Or should I go back or say, oh, wait a minute, I need to do a little more research on this? Or, of course, maybe this isn't the business for me.
Correct. The purpose of asking for these is really to identify red flags, if there's anything that stands inconsistent with the information you're given, and to, determine that, unpaid taxes, like we talked about earlier. Because especially if you're buying the stock of a company, and let's say it's what's called a C corporation, where the corporation is liable for the tax. And if you're buying the stock, you therefore become liable for unpaid taxes of the corporation. So it is important, especially in a C corp sense, to ask for tax returns, to make sure that you're doing your due diligence. You're not taking over liabilities that shouldn't be yours.
Which is, once again, whether you're beginning a business, buying a business, selling a business, you should really talk to your tax professional first. At least that's how I feel about it after years of dealing with businesses, finding out about them at tax time.
I'm sure, yeah, we both have had times where we find out there's someone that I've just been preparing. They maybe have some income, wages every year, and they come to me and April 1st and sit down with me and say, oh, forgot to tell you, I bought a business this year. And I said, what? Probably should have had a conversation halfway through the year about that. So even if you're a cowboy, at least tell me about it prior to tax time.
Yeah, at least then. At least before December 31st, so we can figure out something. Because once December 31st comes and goes, you're stuck. All we can do is work with the numbers that are there. We can't change them or anything. So
correct. The chips fell where they fell after December, once December 31st rolls around. And especially if this is your new venture into a business, there's a slew of taxes and self-employment tax that you may face, that it's so important to talk to your tax professional, your CPA, accountant, EA, to make sure that you're not getting walloped with the tax bill, at April 15th.
Yeah, it's definitely there. And Gennaro, we do really want to thank you so much. There's so many good reminders, so much good information here that we've had today on whether you're buying a business or selling a business, tax strategies you need to use or things you need to keep in mind. Of course, the biggest one everyone should take from this is you need a tax professional if you're going to do this. And certainly myself or Gennaro are available for this. How can ones reach you, Gennaro, if they want to reach you?
So if they wanted to reach me, my email is Gennaro, Genaro, hortnesscpa.com, spelled HJORTN as in Nancy, ESSCPA.com, or easier, if you don't like all those syllables, is to do 920-725-1040.
Okay, and thank you, Gennaro. And certainly, if anybody has questions about today's program or any of the programs on the Tax Answers Advisor, you're certainly welcome to email me directly, success@cashtracksfinancial.com. You can visit cashtracksfinancial.com to schedule your free mutual exploration session. Once again, to come together for both business and individual matters to help you as the taxpayer pay as little tax as possible. Of course, you can also give me a call here at 844-394-4287. Again, so much we thank you, Gennaro, for your time today and educating us all on getting past some of these headaches and problems with buying and selling a business. And we'll talk to everyone again next week here at 9 a.m. Pacific. And certainly, we really thank you for listening to the Tax Answers Advisor with Marcelino Dodge on the Voice America Business Channel.